For research-intensive firms, accounting standards make it difficult for analysts to assess the performance of the firm because the accounting standards force firms to expense research and development. So on the screen here, I have this buyer group and the financial statements or an excerpt from the financial statements of buyer group and specifically the income statements. So here we see R&D, quite a lot of R&D expenses expensed right away, which means that earnings are dragged down by these expenses, even though they are and could be considered as investments for the future, and therefore theoretically could be capitalized. However, the accounting standards say that research expenses should be recognized through profit and loss. Here, Bayer also says in the note that development expenses are only capitalized as internally generated intangible assets if the recognition criteria of IAS 38 are met. And usually those recognition criteria are not met for a pharmaceutical company like Bayer because it's so uncertain whether the money you put on new drugs will develop into future revenues or not. So what we have is basically a situation where sales one year are not matched to expenses in the same year, because the sales that we see in 2019, for instance, here, are not connected with the R&D expenses in 2019. Instead, I guess it would be maybe some R&D done many years ago that developed into some patent, and that is the reason why Bayer have that amount of sales today. So the research expenses that we see here will likely develop into revenues somewhere in the future. So just looking at how much they spend on R&D, we can see that they spend quite a lot of money. They also have a lot of employees involved in the R&D operations. As analysts, we can then consider that R&D should be an asset, and we can try to put it back where it belongs on the balance sheet. So how could we do that? How could we capitalize all R&D in this company? Well, we need some assumptions. Assumption 1, straight line amortization over the average expected life of the investment. So we use 5 years as a straight line depreciation over 5 years. Then we have second assumption, R&D spending occurs evenly throughout the year. So it's not like Bayer has ceased investing in R&D. Instead, they focus on it all of the time and also seem to focusing more and more on it over time. So the assumption will be something like the latest year's spending, only half a year will be amortized off that. So these assumptions, amortize over 5 years, straight line, and the latest year, only half a year. So if I put everything together and look at 2018, 2019 for this company, I have the actual outlays, and I need to do some adjustments. So first I need to focus on 2018 first. What should I put as the asset? Well, first of all, I have this, I need to calculate how much the asset value will be. So out of the 5.1 expense in 2018, I will actually put 0.9, so 90% of that as an asset. I do this calculation 1 minus the amortization rate times the past years. So the number of past years. So in the first case, I basically do 1 minus the amortization rate, which is basically then 1/5. And the number of past years in the first year would be 0.5. And this will give me 0.9. So taking 5.1 times 0.9, 90% of 5.1 would be 459. So that is how much I allocate to the asset side out of the 2018 outlay. I do a similar exercise for the other years. 2017 value is 4.5. So that I have already, that is now like 1.5 years ago. So for that value, I take 1 minus 1/5 times 1.5. I get 70%. So 70% out of 4.5 will be 3.15. And that is the asset value for that year. So this value will be decreasing then over time, since more and more has already been amortized. But altogether, the asset value for 2018 will be 7 billion. Okay? When I do this adjustment then on the balance sheet, I increase the intangible assets with 7 billion and then split this up as an offsetting deferred tax liability and shareholders' equity. So I use 25% tax rate here. What about the income statement then? What can I do? Well, first of all, I need to remove this R&D expense of 5.1. I don't think that should be there. Instead, I need to calculate how much is amortized. And I do this, I have this helping column right here, which is based on the fact that, okay, straight line amortization, so 1/5 every year, except like the first year and the last year. There I take half of that. So what it all boils down to is that I take 10% of the 2018 expense, which will then be out of 5.1 billion, I have 0.51 billion. Okay. Next year, 1/5 of 4.5 gives me 0.9. 1/5 of 4.4, 0.88. 1/5 of 4.3, 0.86. 1/5 of 3.6, 0.72. And finally then 1/5 times 0.5 times 3.4, 0.34. Take these together, I get 3.7. And that should be the new R&D expense on the income statement, I think. So a profit loss, it seems here, of course, the profit will go up, so there will be more taxes as well, a slight increase in taxes, but profit loss before tax, 1.4. Similar exercise will then be done for 2019. I have 5.3 in 2019 as the actual R&D outlay. What happens with this 5.3? I need to take it away from the income statement first. Okay, then I calculate the asset. What is the R&D asset? So 90% of the current year will be translated into the asset side. 0.7 for 2018. So we see here that the asset in 2018 coming from 2018 was 4.59 first, then only 3.57 is left in 2019. I do this calculation for all of the years, end up with 12.3. 12.3 ends up as the intangible asset, intangible R&D asset, and I do then the offsetting deferred tax liability of 25%, and the balancing goes to equity. If I do the amortization exercise once again, take 1/5 times 50% in the first and last year, due to this spending evenly throughout the year assumption, and then 1/5 every year, every other of the 4 years. So if I sum, of course, if I sum all of these together, let's see, I made a mistake. If I sum all of these together, so this is like, the sum is 100%. So over 6 years, everything will be gone. Everything will be amortized. But this is then the numbers I'm going to add together, and adding them together gives me 4.6. So 4.6 is the amount I'm increasing the R&D expense with after I have taken away 5.3, which was the original number. So here again, 700 million positive profit impact before taxes. So maybe this is the true earnings if we consider R&D to be an investment for the future.